Okay, so in this video, I'm going to be sharing with you a much safer way for you to trade the wheel strategy, especially if the market crashes, because this is one of the things that many people fear when they start trading the wheel strategy. So although this is something that many people fear, the interesting thing is that not many people actually have a concrete plan as to what exactly to do when the market actually crashes. So this is where a lot of people get into the wheel strategy, the market suddenly crashes, go well below their options, they're deep in the money and they're seeing a very deep loss, then they panic, right? So that is actually what happened over the past few weeks when, the tariffs hit the market and all of a sudden the market had a very big move down. So during those past few weeks, I actually had quite a number of people reach out to me asking me for help because many of their positions are deep in the money and they have no idea what to do. So let me just give you an example over here, and that is on Nvidia. And the reason I choose this is because I had somebody actually reach out to me to let me know that they did the wheel strategy before the market crash, right? Before Donald Trump actually introduced the tariffs. So if I'm not mistaken, the person entered into the wheel strategy by selling the cash account put first at around $140, somewhere around here. So as you can see over here, this is where he sold his cash account put, and after selling it, the market has gone much lower than that, and he has gotten a sign and is seeing a very big loss. So this is where a lot of people have no idea what to do because they just enter into the trade thinking that they're just only going to collect the premiums with no intention of getting a sign, or for some reason they don't even think that getting a sign was a possibility. And then when it actually goes below their cash account put, they become a deer in the headlights. They're not sure what to do. So at this point of time, of course, as you can see, Nvidia has kind of recovered already quite a bit. But what if Nvidia had continued to go down? If it had continued to go down, then this position over here, which you probably would have already gotten assigned 100 shares, it's going to be much deeper in the red. And even though right now, let's say it has recovered, we don't know for sure, is it going to go back up? So at this point of time, the only thing you can do really is to hold on to the shares without doing much. So the question is there a safer way for you to trade the wheel strategy in the event this such move happens again? And the answer is yes. So this one I'm going to go through in this video. So there are 4 key steps for you to do to trade the wheel strategy safely. So what are these 4 key steps? So the very first step is regarding stock selection. Second step is trade placement. Third step is option selection. And finally, the fourth step is trade strategy. So I'm going to go through all these steps with you, starting with the very first one, and that is stock selection. So for stock selection, basically there are 2 key points that I would like to touch on for this. And the very first one is to select the stocks that have strong fundamentals. And this is something that you probably have heard me say over and over again. However, I still get many people reach out to me saying that they got into a certain kind of stock where I can clearly see it's not a fundamentally strong stock. And the reason they got into it is because of the high premiums. So you see, one of the things is that with the wheel strategy, you can have a lot of all these stocks that you get into, and then many of them may not be fundamentally strong, and you get the high premiums for that. And for the most part, maybe you can get 80%, 90% of the time, you're just getting the premium, never getting a sign, the market never crashed. It's all good. But once you reach that one stock where you enter into the wrong stock, where you just purely entered because the volatility is high on that stock, you get a lot of premium, and then all of a sudden it crashes, it never recovers, that can really take a very huge hit to your whole account. So that is why, for me personally, when I trade the wheel strategy, entering into a fundamentally strong stock is very important. So what is considered strong fundamentals? Now, of course, there are many things that you have to look into for this. So you definitely do want to do your due diligence, like for example, free cash flow, strong balance sheet, whether there's a economic mode and so on and so forth. But for this video, I'm just going to keep things pretty simple. And one of the things that I really like to glance at least at the start, for me to decide whether this stock can be potentially good for the wheel strategy, is to see whether this company has increasing revenue and profit over the past few years. Because one thing that you need to understand is that this is not just some ticker that we're trading. All these are actually companies. So if the companies are not profitable in the first place, then what are the chances of the stocks actually going up? So this comes in very important, especially when the timing is wrong. Because as you know, we can never get the timing always correct, because as much as many people try and enter at a time whereby, the market is at a point where the moment they sell the cash account put, the market goes up, all is good. But when the market just goes all the way straight down, then this is where you need to rely on whether the stock is fundamentally strong or not, because a fundamentally strong stock can eventually have a much greater chance for it to recover. So one thing I like to do is to just head on over to Google Finance and just look at the stocks that you're interested in. So for example, we're just going to use Nvidia in this case, since I already brought it up in the chart just now. So I'm just going to type in Nvidia over here, just hit enter. And as you can see over here at the bottom, you're going to have some details, right? You're going to see like there's earnings forecast, there's the news, and so on. But what I'm really looking at is this one down here, which is the financials. So you can take a look at the income statement for quarterly, even the annual one as well. And what I really want to see is that there is increasing revenue and increasing net income over the past few years. So as you can see over here, Nvidia did pass this criteria, and clearly it did. Now, of course, certain years maybe at a slight dip, but overall, as you can see over the past 5 years, it's generally increasing. So this is something that I do like to look at. So once you have a company that at least you see over the past number of years, it has been increasing its profit, its net income, then at least there is a greater chance that the stock price can also rise over the medium to long term. So the last thing you want is to get into a stock that is not profitable at all, and all of a sudden it faces bankruptcy. Then everything that you have put into the wheel strategy for that stock is pretty much going to go to zero. So this is an important step. The next one that I look at would be strong technicals. So what do I mean by strong technicals? Well, strong technicals basically just means that if you were to go to the chart, what I like to do is to just zoom it out to the much bigger picture. So maybe I just go to the monthly time frame. And what I want to see is that over time, has it gone higher? Has it actually made new highs? And if it has, it just means that if there's going to be any crashes that is to come in the future, at least I know that it has actually withstand the test of time in the past, over the past few crashes, and still continue to go up. For example, as you can see over here, Nvidia has gone through a few market crashes as well. So in 2020, the pandemic, 2018, around there, this is where Donald Trump had his first tariffs, and then 2022, and then the market still continued to go up. So all this is pretty important, especially if you are planning to trade the wheel strategy, where you can actually be caught in a stock for quite some time. So if you are caught in a stock for quite some time, in the sense whereby your assigned price right now is much higher than where the current market price is, if it has strong technicals, then at least you can be much more comfortable holding on to it until the price eventually recovers. Okay, so that is what I mean by having a strong technicals. Now, the next step is trade placement. So trade placement, again, same thing. I'm looking at two things. So the first one is to split your risk allocation into tranches. So what do I mean down here? So what I mean is that for the stocks that you have decided to trade the wheel strategy on, most likely you already have a given capital allocation to it, a certain risk you want to put into the stock. Now, how most people do it is that whatever allocation they put into it, they're just going to put it into just one cash account put as to enter into the trade. So let's just say, for example, you have $50,000 just to put into a certain stock. Most people just enter into one level. But what we want to do instead is to split into different tranches. So let's just say, for example, you have decided that maybe you want to enter at $115 as an example. You want to do your cash account put down here. So if your risk for this stock, let's just say, is $50,000, then you're probably looking at about 4 cash account put around there, right? Around 4 cash account puts, 4 contracts or so. So instead of doing all this in just one position, what we want to do is we want to split them into tranches. That means to say we do not want to enter all 4 contracts right now, but rather we just want to enter one here, and then we want to split them up into different levels. So this way, as you can see over here, we actually have cash account puts on the way down. So what does this do? This, number one, it does is that you can continue to sell this cash account put even as the market goes down. Because one of the things that many people get stuck doing is basically they sell the cash account put, their full position at one level. Let's say, for example, here, then all of a sudden the market crashes, they get a sign, then there's nothing left to do. All they can do is just to hold on to their stock. Like what I mentioned just now of this other person. that reached out to me. He had at $140. All he's doing right now is that he's holding on to the stock, waiting for it to eventually recover. So this is one of the limitations when you have just one level. So instead, when you have more than one level of entering, you split them into different tranches. Then this way, as the market goes down, you can keep selling it as well. So not all will necessarily be assigned at the same time. So let's say, for example, all right, let me just make this back to one contract. So let's just say, for example, the market comes down, it expires here, then this one now becomes 100 shares. So once this is 100 shares, now you have another one, you can keep selling it. So this one, you can sell the cash secured put again, and maybe this time the market goes back up somewhere down here and it expires. Well, at this point of time, you can still hold on to the 100 shares, but you can sell this cash secured put again because it has expired worthless. You can sell it again. So you can keep doing it regardless where the market goes, as long as you have already planned for all these levels up to, where you feel comfortable getting your last point of entry. Now, the other thing is that if you do eventually get assigned on all of these levels, let's say you do get a very huge crash whereby all your levels are assigned, then guess what? You'll be better off than if you had all your contracts in just one level down here. Because when you're assigned on all these different levels, guess what happens to your average price? It actually is lower as well. So your average price would most likely be somewhere over here as compared to the person who had sold it everything at just one level up here. So what this also means is that it's easier for you to break even when the market comes back up. And from here, you can also start to sell your covered calls earlier as compared to this person down here where he had to wait for a much bigger move up before he can sell his covered call. So this is what I mean by splitting into tranches. And when you do it this way, you're no longer as afraid of a market crash, because if the market doesn't crash, then guess what? All your other 3 cash secured puts that you have planned for doesn't really come into play. So in a sense, you're kind of welcoming the crash, because then this is how you can get a better price overall when you get assigned, and you can still continue to sell these premiums even though the market goes down. Now, the next thing I look at is to see whether it's below the fair value. Now, this one is not necessarily mandatory. It can be optional, but if you use it, it's going to help you err more on the safe side. So the question is, how can you find out about the valuation of the stocks that you're planning to do the wheel strategy on? By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. And this is where you can go to the different websites. So there are many different websites that can help you calculate the valuation of the stocks. So one of the sites that you can look at would be simply Wall Street. So as you can see over here, this is a site where it can tell you quite a number of things about the stock that you're planning to do the wheel strategy in. As you can see over here, it goes through the valuation. You can see the future growth, past performance, financial health, so on and so forth. So what you can do is that once you come to Simply Wall Street, right, you can even do this with a free account, by the way. And then from here, all you got to do is just type in, what is the stock that you're looking at? And then it will give you this overview for you to take a look at. So you can see over here, these are some pretty interesting details for you to know, right? Earnings are forecast to grow at 20.7% per year, trading at 5.3% below our estimate of its fair value, so on and so forth. So you can definitely go through here and have a much deeper insight into the stock that you're planning to trade. So over here, what we want to do is to go to the valuation one. So once you click the valuation, you can see that this site will give you its own valuation. Now, is this valuation 100% accurate? Of course not, right? Because valuation is really derived based on different calculations depending on the person. So what you can do is to go to the other sites as well. You just do a Google search and there's going to be many different sites that will give you their fair value of what they think about the stock. And then you can get an aggregate out of all of them. And on top of that, you can even discount the fair value even more just to be on the safe side. So for example, if you see that the fair value is 137 based on this website, then maybe if you want to be safe, you can say that, okay, the fair value is 130. Then you'll only initiate the wheel strategy below this fair value. So as you can see over here, based on this current fair value of this website, it's saying that it's 137. So the current price is actually below the current fair value. So you can start to do the wheel strategy if you want to base it off of this fair value. So why is this also helpful? to help you trade the wheel strategy more safely? And the answer is that if this fair value holds true, it just means that over the long term, the price will eventually gravitate to this fair value. So that is why if we were to enter it below this fair value and we were to split it into several tranches, you can see that we are going to be much more safer in our wheel strategy, because let's say if the market really crashes, then in the long term, we can at least say that based on this fair value, it has a higher probability for it to eventually goes up. Now, of course, provided that this stock is fundamentally strong. Like I mentioned, that is very important when you select this stock. Next, step 3. Now we get into the option selection. So we never get into the option selection first, which is something a lot of people do, because what they tend to do is that they just want to see how much premium they can get first. And they'll just go with the stock with the highest premium, and then they ignore the first 2 steps. So with what we're doing, if you want to be trading it much more safely, especially if you no longer want to fear a market crash again, then you want to go through this step. So now step 3, we're going to get into option selection, and same thing, we're going to get into 2 things down here. So the first will be DTE selection, second will be strike price selection. So for this, let's head on over to the option chain, and then let's discuss what is the DTE and strike price selection over here. So the very first thing is you want to decide what is the DTE to choose. So you're pretty much faced with just 2 choices in general. Either you can go for the very short-term one, and what I mean by that is maybe a week or so or less than that, or something around 45 DTEs or so, because according to the Tasty Trade studies, this is where we have the edge, where the realized move is more of the time lesser than the expected move, which means to say, if you choose the option strike prices around 45 DTE, that just means is that you tend to have a slightly higher win rate than the theoretical win rate. However, when it comes to the wheel strategy, this to me doesn't really play too big of a part, because I'm not trying to avoid assignment, but rather I actually do welcome the assignment. That is part of the wheel strategy, because a big part of the profits that you're going to gain from the wheel strategy actually is the capital gains. That means you get assigned on the stock, and then from there, when the stock actually goes above your assigned price, you're going to get capital gains. So you want to get all 3 types of profit from here. Basically, the premium you get from selling the cash secured put, the premium you get from the covered call, and then also the capital gains. So if the focus really is to get assigned quickly, then you want to go for the lower DTE as well. Because with the lower DTEs, it gives you a higher probability of getting assigned once the market actually goes below that strike price, because there are lesser days for you to wait. If you go for the 45 DTE one, what can happen is that the market may go down maybe within the first 7 days of putting on this option, and then closer towards expiration, it goes up, and then you're no longer assigned. Now, of course, you get the option premium. That's all good. But had you actually gotten into the stock and the price really did continue to go up, then you would have actually gotten much more than the premium which you receive for selling this option. So that is why this is where you need to really decide for yourself whether you want to prioritize getting assignment, or do you want to just prioritize, getting more of this premium. So remember, it's always a trade-off. So one thing you need to understand is when you go for a shorter DTE, you can't really get a further out of the money strike price. So for example, let's take a look at the chart again. And let's just say, for example, the price you're looking to probably get assigned at will be around 115. Let's just use 115 as an example over here. So this is where you're planning to sell the cash secured put. Now, if you were to go to the 3 DTEs and you want to sell the 115 strike price, all right, let me just remove these drawings. Take a look at what is the premium. As you can see over here, the premium pretty much is next to nothing. It's only 6 to 7 cents. You're pretty much not going to get much for selling this strike price. But if you were to go to the further out of the money one, and you take a look at the 115 strike price, you can see that actually you can get a little bit more, right? In fact, much more. You get about $2.70 plus, which actually equates to $270 per option contract. So this is something that you need to realize, especially if you want to go for a further out of the money strike. Now, before I get deeper into the strike price selection, what you notice is that my ladder down here on the option chain might look slightly different from yours if you have been using the traditional way of the option chain. As you can see over here, as the prices go down the ladder, you can see that the prices are lower. But on your one, you probably, if you have the traditional one, you will see it's the opposite. That means as you go up the ladder, the prices actually become lower. So it might be a little bit confusing for you. So if you're using Tasty Trade, you can actually adjust this. As you can see over here, down here, you can just click this arrow. This is the default. As you go up the ladder, the prices get lower, and on the way down, the prices actually increases, which kind of messes up with a lot of people, especially the beginners when they start to trade. So I find it actually helpful for the beginners if you were to have this option and then you change it. And this way, if you were to take a look at the chart, you can see that it pretty much reflects the same kind of arrangement, right? As the price goes down on the chart, the price becomes lower. Similarly for the option chain as well. Okay, so now the next thing you want to consider, whether you're choosing 45 and 3 DTEs, let's say in the extreme, is the premium. So let's just say, for example, the fear that you have is in the market crashing. So if you're fearful that the market is going to crash, then maybe going for a 45 DTE might be better than the 3 DTE, because in this case, let's just say, for example, we use the 115 example again. Over here, you can actually get much more premium to kind of cushion the downside in case the market really goes down. So if the market really crashes, at least you have already received $2.72, which is much more than the 6 or 7 cents for the 3 DT. And this can really help alleviate some of the drawdowns that you have as the market goes down. And eventually, if the market goes back up, then you're going to make more as well, because again, you have already received this premium. So this is something you want to take into consideration when you start selecting your options. Finally, we get into step 4, and that is trade strategy. And that is to have staggered cash secured put entries and staggered covered call entries. So like I mentioned earlier, we're going to be getting it into tranches, but that doesn't mean that we sell everything at one go. For example, let's just say the very first level you plan to enter will probably be, say, 120. And then maybe after that, the next one would be probably 110. And then the next one will be another 10 points out at 100, and then at $90. Let's just say, for example, this is what you've decided to go with. By the way, there's no one fixed way for you to do this. This is up to you to arrange it the way that you feel comfortable. So let's just say you want to go with this. Now, you do not immediately sell all 4 of this cash secured put at one go. Why? Because chances are that you won't get any premium for this bottom 3 because they are just too far out of the money. So what we want to do instead is to stagger our entries in a sense whereby only at the start you want to start off with this first one. So as the market maybe comes down, this is where you want to decide, do you want to sell at the money or further out of the money? And then based on the strike price level that you want, and then you start to sell the first cash secured put. And then once you've already sold this, only when the market goes lower from the first cash secured put, then you can start to put on the second one. And when it goes to the next one, you get into the next one as well. So as you can see, we are always staggering it. So same thing, if the market goes back up and then this 2 starts to expire worthless, so now you no longer have this 2 cash secured put, then at this point of time, because it's below this 120, you can start to sell this one again. So you sell this one again, and then same thing, you wait for it to go down before you sell this one again. So as you can see, we're always staggering the cash secured put rather than entering it all at once. Now, this also works on the other side, which is the covered call. So let's say, for example, you are already now assigned on these 2 levels. So these 2 levels, let's just say you got plus 100 over here, and you have another plus 100 shares over here. Then this is where you only want to sell the covered call for each individual level once it goes above that level. So let's say, for example, it comes to this point. This is then where you sell the first covered call for this one down here. So maybe the first covered call, as an example, let's say you sell it somewhere down here. So this will be your first covered call. Then once this actually goes above the very first cash secured put that you sold, which is where your assigned price is, then you can sell the next covered call. And when you do it this way, what you notice is that you'll probably be constantly selling all this cash secured put as well as the covered call, depending on where the market is. So you're never in a position whereby you're just stuck with the shares and there's nothing for you to do. Because if the price is always constantly around these few levels, then you can always start to sell this cash secured put and even the covered calls as it goes above these levels. And the next benefit of this is that you actually also get much bigger capital gains as well. Then compared to selling the cover call just at where you actually sold the cash secured put. Now, you can definitely do that. However, this is where you will miss out on the capital gains because like I mentioned, capital gains can play a very big part in the overall net profitability of this strategy. So I would definitely suggest that you do sell your cover call at least above the cash secured put or where you got assigned to at least get some capital gains. So hopefully this video has been helpful for you, and if it has, I would greatly appreciate if you give me a thumbs up and also subscribe to this channel for more options videos like this, and I will see you in the next video.